This is the Definitely Uncertain podcast, brought to you by Goldrock Capital. Each week, we look at how high net worth families can improve their lives, decisions, and investments in a deeply uncertain world. We always aim to provide practical information, even if we can't offer specific investment advice.
Welcome to the Definitely Uncertain podcast by Goldrock Capital. My name is David Ram, and I'm a partner at Goldrock Capital, the more than 20-year-old multifamily office servicing high net worth investors in Israel and around the world. And with me today is Peng, based in Hong Kong, and is the head of investment strategy for the Asia Pacific region at Citi Private Bank. Welcome, Ken.
Thank you. It's a pleasure to be here.
Thanks so much for joining us. So today's topic is going to be investing in China and the Chinese equity market mainly. So perhaps to kickstart, Ken, can you give us a bit of background on yourself and your personal story as well?
Sure. Well, I've spent 22 years now in this industry, in the financial industry. I actually started in New York in 2000 to cover U.S. economy, and then in 2008. I came back to Asia, first in Shanghai and then in Beijing, and spent about 10 years as a China economist. And then I came to Hong Kong into this role, and I've been here for a number of years as well.
Wonderful. Great. Well, thanks so much for that. And China is an interesting place to invest. And, as a family office, we try and identify what we would call, major secular trends in various markets and take a deeper dive in those areas in order to identify investment opportunities. And China, of course, as a global economic powerhouse now, is one of those secular trends that are happening in the world. So the first question I have relating to Chinese equity market, just to kickstart the process, is it's really underperformed global equities over the past couple of years during the COVID crisis. Why is that? What happened?
Well, in the first year of COVID, it wildly outperformed, and then it was all over. But I think you can summarize what happened last year in 2021 in two factors, right? One is the pretty severe regulatory tightening on the darling industries of the market, like e-commerce, education, and some healthcare, as well as consumer brands such as Multi, and so that happened. On the other hand, at the same time, there was a severe tightening in credit conditions in China, where this is kind of overlooked by a lot of people because the regulations really take all the headlines. It's that when you look at new credit to GDP ratio, that shrunk last year by 9 percentage points of GDP. And that's had the effect of pretty significant valuation compression. And I think something similar is happening in the US market now. But generally speaking, it's the combination of credit tightening, which is directly related to the real estate sector, and the regulatory tightening in the tech sector.
Interesting. So let's start with the regulation for a second. You mentioned markets like education and other tech parts as well, where regulation seemed to have come out of nowhere in some markets. And one of the worries around investing in places like China is the visibility on changes in the market can be limited. How does one navigate as an investor in the Chinese equity market when regulations can change dramatically the whole story?
I think it's slightly incorrect to say that it came out of nowhere.
Okay.
The antitrust regulations, the legislation for antitrust regulations were passed in January of 2020. But nothing happened for a year because of the pandemic, right? And I think there was a sense that in the Chinese society, that the common person, the people, have redirected their aspirations from from something that aligned with communist governance to something more aligned with the Jack Ma brand of aspirations, right?
Mm-hmm.
And so before the internet guys came, there was real estate, and everyone's purpose in life is to make enough money to buy more properties. And so that, and now it's like, you want to be the internet startup, right? So to get eyeballs and clicks. So that's that's rather misaligned with what the leadership had in mind about the direction of the nation. And so they wanted to change that. They wanted to change that through antitrust. But I think the market, a lot of investors didn't believe that they would go at it so hard and so quickly. Basically, half a year, they've done regulations that could have taken decades in economy like the US, right? So this is it's the intensity rather than the direction that really shocked people. Right. And so along with that, you have this common prosperity theme to all these regulations and all these changes. And I think that's good in a way that it realigns, rebalances the direction of the economy with that of the nation, and so that you could avoid bigger problems, accidents further down the line. And so this is how I view this, grand scheme of things. But of course, on the ground, it was quite painful in terms of losses to these equities. Interesting.
Yeah. So in terms of the intensity and the speed, it seems to be is what you're referring to more than the direction. That's interesting. Because I know you spoke about technology being a major driver of wealth creation, and then buying your second apartment, which is exactly how things happen where I'm based in Israel. Tech is a major force in the Israeli market. So that's very similar story here as well. Bringing it to the credit issue you mentioned as well for a second. I guess there's two sides to that story, which is one, they tightened, and that has obviously affected equity valuations this past year. That also allows maybe for more ammunition if they need to loosen policies in the future if the economy begins to slow. So from a forecasting perspective, thinking about 2022, maybe beyond 2023, GDP is a major driver, of course, for economic growth and equity performance as well. And real estate has been, I think it was about a third, if I'm not mistaken, 30% or so of the overall GDP in China. After the Evergrande story, at the same time of credit tightening, what is the forecast from your perspective as to how the government will respond and how that may affect Chinese equity investors as well?
Sure. This is several questions into one, right? Let me first address how I think the real estate situation is going to evolve.
Yeah.
And then from there, we can talk about how the economy might turn the corner. I think this year, and sprinkled over top of that is a healthy dose of politics, which is very important this year. Yeah. So the real estate, it's the tightening in the real estate market really started back in 2012. It didn't really kick up to a more serious gear until I think 2017. But throughout this entire process, some of the smarter developers have figured it out, right? They need to reduce debt, and they need to be less dependent on high turnover projects. And that way, and also increase size, that way they can be safer and not too dependent on immediate refinancing. But then there's a few others, such as Evergrande, who thought, all I need to do is to get bigger.
Right.
At all costs. Once I'm big enough, I'm too big to fail. And, I can just, go through things. That turned out to be false. And during this process, we racked up a lot of debt and created all kinds of fancy new businesses like electric cars so that he can borrow money. And that's really not healthy. And so, it turns out that, he's not big enough not to fail. And what needs to happen now? There's a pretty clear blueprint on how to digest risks in the real estate sector, which is to get state money to fund current construction of finished projects and to basically take over assets of troubled firms. This process is going to take time. It's not going to be instant like that. But I think they've gotten the latest updates that they got, the state asset managers. So basically the bad debt managers, distressed debt managers owned by the Ministry of Finance to help lead the deals to consolidate the real estate industry. I think that is the correct way to go forward, but they just need to provide enough deals quickly enough so that the default risks do not spread to the healthier developers. So that's how that part of the economy is going to evolve. At the moment, we still have a big hole in terms of real estate sales and investments. And like you said, that's the whole supply chain is about 30% of the economy. And that's still deeply in the negative.
Right.
And so what needs to happen is to restore consumer confidence in purchasing real estate. And that's been damaged by the fear that projects pre-sales might not be finished. So they need to supply enough money for these projects to be finished.
So it's primarily a residential real estate story, it sounds like. Is that correct? Okay.
Yes.
Okay.
So that needs to happen. And what is amazing is China had essentially gone through 2 recessions in 2 years, right? First, because of the pandemic in early 2020, and second, because of tightening in late 2021. And now it is in the stage of the second round of easing, when the Fed is tightening pretty substantially by market expectations at that moment. And so why are they doing this? I think the tightening from last year and the easing this year are all in some ways connected to the Party Congress to be held this October.
What's the Party Congress?
Tightening.
What is that?
Okay, so every 5 years, all of the all of the representatives of the Chinese Communist Party meet in Beijing and have this big national meeting, and this is when the leader, the party general secretary is chosen for the next 5 years. There's very little doubts that she will continue on, but in the process, he needed to do, I think, 3 things, right? The first is to make sure that he can do this for a third term, and that's already done last year. The second is to make sure that most of the representatives, the people that the representatives represent, are aligned, right? And so I think there were a lot of voices coming out of the e-commerce space, that weren't congruent with that with that view, and so that's done as well last year. And finally, the provincial, so the one downs from President Xi need to be, I think, replaced. Well, generally, a lot of them are retiring, a lot of them moving on, and so there's a lot of that personnel changes that's still going on at the moment. So in that whole process, last year with the tightening was to fix the first 2, and then this year the stability, the need for stability is to fix the final one. And so there's an interesting. If you, I want to show you a chart, but if you look at how credit growth behaves during years of Party Congress versus years in between, right? So every 5 years, this is Congress, right? The credit growth goes up. in between, the credit growth is almost negative. It's
Right.
mostly negative, right? I mean, there was 2009, 2020 that were exceptions, but those were very special exceptions. Other in between years were all pretty negative.
Okay.
And along with this boost in credit growth, you have strong equity returns.
Right.
We're talking about 20 to 60% types of regular equity returns for the MSCI China, right? And the year before Congress tends to be pretty bad because that's when the anti-corruption, the reform stuff.
They're cleaning house.
So it's happening again. China goes through these mini cycles, and so that's why we're pretty confident that this year is a year of repair in terms of valuations, partly because of the credits and partly because of all that tightening from regulatory perspective stabilizes this year.
Interesting. And just to bring it into a bit of a broader political perspective, just for a moment, don't get too deep into it, but obviously U.S.-China relations as well, as China does build their 5-year plan and they formulate their next move politically, there is obviously ongoing tensions with a major trading partner, which is the U.S. Does that have any effect? Of course, it has an effect, but what's the meaningful effect, I guess you could say, of that tension that you see politically, and how they're going to build the next 5-year plan in China, and what will that feed into the equity markets, if any?
Sure. This is so the U.S.-China relationship is going to be relatively tense for many years to come. So I think it's going to be a fairly gradual attempt at decoupling. But because the economic interests are so intertwined, I don't think they will ever be able to completely decouple. So we're going to go through these, ups and downs in terms of relationship in a generally more intensive competitive relationship. Yeah. And this year, because I just talked about how politics is important in China, it is also important in the US.
Right.
Right, because of the midterm elections in November. So I don't think there is a whole lot of interest in Washington, D.C. to make this relationship painful for anyone. We've seen that during the worst of the trade wars in 2018, there were a lot of farmers, industrial workers, and in the U.S. that were unhappy, right? And so there's that. So I think this year is actually a year of respite in this relationship, but it's unlikely to change that much because Biden also doesn't want to seem like it's being too soft on China.
Right.
Yeah.
It seems to me that also because of the inflation story that's happening primarily in the U.S., I'm sure there's some inflation in China as well. But it seems to me, I'm happy to get your view on this, that since the COVID pandemic, there's been some noise around supply chain diversification in the U.S., where we're not completely reliant on China for the stuff in the U.S., right? For pharmaceuticals, for example, which is a major. China is probably 90+% of the pharmaceutical ingredients and components of things like antibiotics and other things. There seems to be a lot of noise around diversifying those supplies. But when inflation is so high, and obviously being diverse in your supply chain could increase inflation even further, I think there probably has been less noise, at least in the U.S. of late. I'm not sure if you agree with that or not, but.
I think that's largely true. What the pandemic had done is to make to make the world even more dependent on China's supply chain.
Right.
So this is a issue that many governments have to deal with, right? So you cannot decouple in this kind of environment. And also in China, CPI was 0.9% in January. So this is it's quite a difference from 7.5% in the US.
Right, and 0.9 annualized.
Year on year, right? And so
wow.
that's problem on the other side, right? This disinflation in China. So they need to stimulate and move up. And so now in terms of this relationship, the most direct impact is how ADRs are going to be treated, right? Because there's
ADRs, you mean the public companies that are in the U.S. that are Chinese companies?
Yeah, so Chinese companies list in the U.S. American depository receipts, right? So in the next year and a half, in the next year and 10 months, the Holding Foreign Companies Accountable Act has it that if these companies, not just Chinese, but all companies but mainly targeted at them because there's more of them, if they cannot meet the auditing standards of U.S. auditors, U.S. regulators, then they'll have to delist.
Mm-hmm.
The vast majority of these companies already have a second listing in Hong Kong. So they can just issue some, they basically swap the
issue new equity shares in Hong Kong and delist in the U.S. essentially.
Basically, yeah. So for investors, if you continue to have interest in these companies, just own it in Hong Kong. For U.S. citizens, that might be a problem depending on which company you're talking about. But for citizens of Israel or Europe or Africa or Middle East, it's not really that big of a deal, right?
Interesting.
Where the shares are. Yeah, and actually the tax treatment in Hong Kong is more favorable than those in the US. So that's that. And there's a few companies who are not listed yet in Hong Kong, and they're likely to be taken private. And normally when that happens, the owner, the people trying to take it private, may want to buy it at a cheaper price. And so you tend to see, the couple of earnings reports before taking private tends to be pretty bad, right? And so that's the risk you're running owning ADRs now. And so I just think it's not really worth your risk, right? Even if you're not concerned about sanctions.
Interesting.
Yeah. So I think that's the thing you need to consider. Is there a second listing? And if not, then probably get out.
That's very interesting. So in terms of back to the planning at the central level in politics in China, one of the issues that has been talked about a lot relates to their zero COVID policy, which has been I guess you could say mixed reviews in terms of its effect. How is that? What are the expectations around the future of that policy and how it will affect the Chinese economy or the Chinese equity markets?
Yeah. So this is a huge debate, right? The virulence of this virus is coming down. We're talking about 0.5% in terms of mortality rate.
Right.
A year ago was 3%. Right. So when Delta hit, that was 3% mortality. Now it's half. But the common flu is 0.1, right? So this is still 5 times deadly than the common flu. So I think
it spreads much more rapidly than the common flu. It spreads
much more rapidly, so it affects a much larger number of people.
Right.
And you take 0.5% of that, it's still a large number of people. So when you look at since the start of this year, the number of COVID deaths globally was about 413,000. Do you know how many are there in China and Hong Kong?
Out of the 413,000?
Yeah.
I'm going to guess 80,000.
50.
50. Okay.
50. Not 1,000, just 50. Yeah.
Oh, 50, not 50,000. 50 out of,
no,
that's it.
Just 50 out of 400,000.
And it's about 20% of the world, right?
Exactly. Yes, exactly. Just 50 out of 413,000. So can you say that it's completely useless? What's the most important human rights? To live? I don't know. So anyway, so that's it's shown effectiveness. But of course, when we get to say Sigma variant, maybe a couple more from Omicron,
right?
The mortality rate goes to 0.1, maybe, right? What to do then? Do you want to have zero traffic accidents? That's just not reasonable, right? So I think there is a strong voice even within the Chinese government to think about alternatives. And so recently we heard from China's CDC head, the chief epidemiologist, basically saying that they're studying plans for alternatives. They can start rolling them out right away, but we still need to consider, a strategy that protects the most number of people, right? And so that's happening. And with regards to Hong Kong, it's probably the city that has the tightest COVID restrictions around the world now, even compared to mainland cities.
Right.
And so now the plan is to have compulsory testing, a more thorough tracking system to be connected with that of China. So I think the reopening in China can take in two stages. Right. First is between Hong Kong and China. And I think that could happen as early as the summer, once this wave dies down. And then the opening of both Hong Kong, China towards the rest of the world might have to wait until after the Party Congress in October. So I'm thinking early next year as a time marker. And then between now and then, there's likely to be gradual small steps towards that. So I do think that the second half of this year could be a period where economic activity booms in this region. Yeah.
Very interesting. Yeah, there's still a 2-week quarantine requirement for travelers into Hong Kong, as far as I know. So you're saying that will probably
from the U.S. 3.
From the U.S. it's 3 weeks because they hate Americans. But if you're traveling from Israel, I believe it's a 2-week right 2-week quarantine. And you're saying that may actually subside in the second half of 2022. You hope, or you think?
I think so.
Okay, interesting.
I think that could subside pretty quickly, because in the U.S. this wave has already faded pretty dramatically.
That's right.
Yeah.
Another topic, just taking a bit of a different direction for a second. Another topic that's very important for the investor community relates to ESG. I don't want to get too down the rabbit hole in the ESG front, but obviously ESG, environmental, social, and governance issues in the Western world is taking a very center stage in how people build out investment portfolios and how people pick stocks or pick managers, et cetera. In China, relative to the Western world, arguably is on a lower scale in ESG terms. But it seems to be going into an improving phase. What kind of attention or what kind of focus do the institutional investors place on the ESG front in equity investing in China? And is it actually impacting how companies operate in the Chinese market?
Yes. So before the pandemic hit, right, ESG has become a very popular thing to follow among investors in China, among foreign investors coming to China, as well as domestic investors, right? So the concept is that it could be difficult to understand how China operates. So we need more rulers, and ESG provides a nice set of those rulers. And so you see, like when you go to these roadshows in China, say back in 2019 or so, a lot of the companies will show you how they measure up according to global standards of ESG measurements. And so I think by some surveys, right, out of 5,000 companies roughly listed in Shanghai and Shenzhen, there's more than half, some 60% of them report such standards. And so it is definitely an up-and-coming trend. And now after with the pandemic, with common prosperity, the ESG movement is getting even stronger, right? first the E, right? So that's probably the most important one, globally, and China definitely is contributing quite a lot. But also the corporates themselves are becoming more disciplined in terms of environmental standards. The G, in terms of governance, China has always been kind of a pariah a little bit, because of lack of information, this and that. But I think as we go through the Luckin Coffee types, those kind of cases, more and more transparency is being put into the regulations, right? So the securities regulator is putting more and more requirements for transparency and disclosure every year, right? And so that the governance standards are also improving. The social standards have a lot of controversy, right? Is it about the freedom of people? Is it about freedom of speech? Or is it about whether this company is doing its share to serve its community? If it's about the latter, then I think what this common prosperity thing have done is to force companies to accelerate their investment into communities. Right, I think
stakeholder equity, for example.
Stakeholder equity, exactly. So in a way, what has happened last year has shocked the Chinese corporate space much, like a huge step forward in terms of the social responsibilities to its community. And so I think in terms of ESG, China is definitely becoming a much more interesting place. The availability of data is improving, and a lot of people pay attention to it. And so I think it's quite interesting here.
Interesting, yeah, because a pandemic, obviously on a global scale in every country practically, the wealth dispersion has widened dramatically. We have people who have made enormous wealth, mainly in tech and other areas like that. And at the same time, people on the lower socioeconomic scale have gone deeper down. So that's a very important social drive, is to try and shrink that gap, I assume.
Yeah, I think common prosperity should be a global standard. It's just done differently.
Right. Last question, Ken. In terms of investors thinking about China as an equity market, for them, sizing is always an important issue when you think about allocations. And when someone is looking at their investment allocation into equity, and the percentage of China within that overall allocation, there's two perspectives. One is, what's the Chinese equity portion of the global equity market indices? And the second is, what's the percentage of Chinese economic power on a global scale, which is a very, very different number, by the way. So when you are advising clients and thinking about how to invest in the Chinese equity market, what's the typical guidance you guys provide around allocations to China within an equity portfolio?
Sure. So in terms of the MSCI global indices, right? China now, including A shares, Hong Kong shares, and ADRs, China measures now about 5%.
Right.
So if you don't even have that, then that's the starting point. But when you look at the market cap of these three markets combined as a percentage of the world, it's about 16%. Right. So a lot of this is not free float, and the MSCI does the free float thing, right? So you can scale that down a little bit, but we're talking about between 5 and 16% should be your allocation, right? And also it depends on your comforts, right? And which sector you want to invest in more. If it's tech, then China should probably have an even higher share. If it's consumer, then China probably should have an even higher share, right? So it's really about your style, your risk tolerance, and your preference, how you view which industries you want to be investing in for the longer term. And so I think the sizing really depends on what kind of investor you are. Yeah.
Right. Super interesting. Ken, this has been great. Really insightful, really helpful when thinking about navigating the Chinese equity markets historically and now into the future as well. So thank you so much for joining us on the podcast. Thanks everyone for listening. Thank you. Have a great weekend.
Thank you. You too. Cheers.